The best trades occur after the masses have been stopped out.
Hope everyone is good. Wanted to run through my gold analysis. So essentially I was going to complete a top-down analysis anyway for the weekend to pretty much just prep for next week and what we're going to trade next week. And the reason I like to redo my top-down every single week is because typically in the week that we've just had gone, in the 5 days essentially of price action that we've had, typically when we go back into the market on the 4-hour, daily, weekly, the price action we've had within that previous week can very much change how I view the 4-hour, the daily, the weekly. And sometimes what can happen if we don't redo our top-down analysis often enough, or we just don't kind of zoom out often enough to remind ourselves of the bigger picture, it's really easy to get caught up in the lower time frames and what's going on in the lower time frames. And unfortunately, what then happens is we start to tell ourselves a story of what's happening on the lower time frame and making predictions based on price on the lower time frame. But then price goes and does the other thing. And then we're left confused because we're like, well, all signs were showing that the market should have gone down on the 15-minute. But then we zoom out and we say, you know what? Now I understand why the market didn't go down, because on the higher time frame, there's actually more signs of it wanting to go up. And I'll give an example of this. You know, for example, if we even look at where gold is right now, if we didn't look on the 3-month time frame or we didn't zoom out, we might have seen that when price was coming down for these 6 months, this was a whole 6 months of price moving from 2012 to 1,617. Now, what could have happened is in the short term, we might have just assumed price is going to keep going lower, it's going to go lower, it's going to go lower, and loaded up on sell positions. But then price ended up reversing, continuing higher. And then we might have saw the reversal here. It's like, it's definitely going lower now. We've had 3 taps of the resistance or whatever you might say, but it's gone and done the opposite thing. So why might we fall into that trap? Again, if we're looking on only lower time frames, we're seeing like breaks of structure, we're seeing supply come into play, we're seeing demand come into play, and that can mislead us into making a false assumption of what price is doing in the short term. Because remember, the short term is happening in order to fulfill the medium term. The medium term is happening in order to fulfill the long term. And unfortunately, what that means is that if we never know the long term, or if we never know the medium term, we never then know what the short term is truly doing. So anyway, getting back into the actual analysis. So it's really, really clear that on this time frame, like, we are going higher. That's exactly what's happening here. You know, price was pretty stable during the first region here. We had a huge impulse up, the retracement and accumulation. We've then had a further move up. We've had a reaccumulation, which lasted for 4 years. We've had a 4-year long accumulation on the market. And now since pretty much last year, we have gone very, very bullish. And we can see for the last 3, 6, 9, 12, 15, 18, 21 months now. I think that is, if I'm calculating correct, we've gone up, okay? Now, the momentum shows not really any signs of slowing down either, so I'm going to assume price will continue higher. We then come down onto the weekly. We can start to see if there's any signs of weakness, I guess, essentially in the market. So this is now revealing me another story where, looking at the market on this time frame, we're seeing again that impulsive move up, move back down, accumulation, we've moved higher. This reaccumulation looks really, really nice. And I kind of want to point out what's happened here, where we've kind of entered a range. We've created some lows within that range, kind of at this region. We've created a clear level of support. But before price could move any lower, what it's done is it's broken and liquidized that level of support. So we've had that liquidity clearance. We've had price hold beneath it, therefore showing signs that it wants to go lower, before then reversing. And we know that's the start of the up move, okay? As we've moved higher, we've had these mini little pullbacks, couple of taps into demand, before we've then just taken off. And we can see what's essentially happened is, since we've taken off and since we've really broken through the trading range, we've just had continued reaccumulations. This area in here, reaccumulation. This area in here, reaccumulation. This area in here, reaccumulation. These areas in here, reaccumulations. What we've just gone through is, again, another reaccumulation. So what I kind of want to tie into this as well is understanding Wyckoff's price cycles in a way that once we're undergoing the markup phase, it's very unlikely to always see big pullbacks into demand zones, because if we were looking for constant demand zone taps during this move, we would have been waiting for a tap here that never came. We could have been waiting for a tap here that never came. As price takes off here, we could have been waiting for a tap into that candle, never comes. Tap into that candle, never comes. And you know, as we keep going, we see there's so many areas we could have waited for price to come back into, but ultimately we understand Wyckoff's price cycles and understand that once price leaves an accumulation or a reaccumulation, it has too much momentum to have those pullbacks into demand zone. So as a result of that, one of my favorite videos I kind of put out actually on the YouTube is different kinds of entry criteria. And what that talks about is how when we understand what phase of the market we're in, we have to understand that there's a different kind of entry criteria that we need to be met in order to enter that phase. Now, unfortunately, what people do is they have no awareness to the different phases of a market or the different cycles that we go through, and therefore try to have a one size fits all approach on something that's changing. You know, one thing that you have to be very good in, and it's actually in a book that I read. I don't remember what book it was called. It might have been the Diary of a CEO book by Stephen Bartlett. It might have been that book. Let me see. I think it might have been this book that he explains it.
A few moments later.
Honestly, I don't remember. It might be in this book. I can't find it. I don't know what it's titled, but essentially what it talks about is, especially in business, one of the reasons a lot of people fail is because they find something that works and then they just stick with that for decades, or they stick with that for a very long time, and they never kind of change. And unfortunately, if we see in the environment and societally, over the last 50 years, we've changed so much as a society. There's been the introduction of the internet, now the introduction of AI. People's attention spans and what we look for dopamine releases in has massively changed over the last few years and few decades. And as a result of that, if businesses fail to adapt to the new times, that's typically the number one reason most businesses fail, is because they don't innovate. Now, what am I trying to say here? It's the same for a trader. If you don't innovate, or I don't know if innovate's the right word in this example, but if you don't slightly tailor your approach to the current cycle or phase of the market we're in, then you're just going into battle with the wrong tool. It's like trying to do your gardening with an axe and trying to cut down a tree with a shovel is essentially what you're doing. You're not using the right tool for the job. Now, getting back to the point, when a market's in a markup like this and it's moving higher with tons of momentum, like we can clearly see in the market, how do we need to approach this? Well, we need to understand we're not going to have those pullbacks. But my other way of entry criteria is by entering in on reaccumulations. Okay, so rather than waiting for the pullbacks, I'm entering in on reaccumulations because I understand these points that are being created are stepping stones to go higher. Therefore, if I'm getting involved, I'm getting involved at the best possible point. Why? Because one of the best analogies I like to use about these reaccumulations is that if we look at an F1 race, after the F1 car has done random number 5 laps, 10 laps, or whatever it is, it needs to refuel, okay? As it gets towards the end of those laps before it needs to refuel, it starts to slow down. So it knows it has to take a pit stop, or essentially in a reaccumulation, move sideways to regather momentum to refuel before then taking off again. We're essentially entering in on the market after the refuel's complete and before the F1 car goes back out to race again at its full speed and full potential. So what I'm going to run through is why we need to enter on reaccumulations and why I believe this is relevant for right now. So getting back into it, we've had many reaccumulations where we could have entered in on. And one thing that I want to actually point out to you guys is whenever we see some form of sideways movement, or we see a reaccumulation, what is typically happening is, starting with this very first example, we create a level of support, which we will typically have 1 to 4 taps of, typically 1 or 2, to create an area of liquidity. And then before price ever moves on, we'll always have a manipulation of the liquidity before then moving higher. The same's happened here, where we started to build momentum, we started to build a level of support, started showing signs of strength to go higher, but the first thing we could do was liquidate the level, and then we took off. If we look at these wicks within this region, you can see how we created so many lows a lot of which tapped in the same region, therefore again creating a level of support, which we can clearly see corresponds with these kind of levels in the market as well. But before we could go higher, we had to liquidize that level before taking off. And we can see as we go up, level of support created, liquidation, move higher. And ultimately, why I bring this up is because when we go on the daily time frame, we can see that that's what's happening right now in the market, where we've had a first tap of a level of support / resistance. We've had another tap to kind of confirm. People are going to be watching for that. The best thing about this is we have a third tap. Again, so many people are putting their stop losses beneath this. So many people are trading this as a level of support or looking to make moves around that. And ultimately, like the reel that I posted into the Discord community chat the other day.
The best trades occur after the masses have been stopped out. And that's because the big fellas up there, they can't press the wee button and get in because there's just not enough liquidity there for them to get in size. So they have to, in fact, engineer 100,000 guys like you, sir. Your stop loss gets hit. That, in fact, sets off a sea of liquidity for them to get in. So even if you don't have the strength to buy at the level, if you can get in and you can see that lots and lots of people have been stopped out before you get in, then you're probably on the right side of the trade. The good trade's always the hard trade, always.
The market makers or the composite man cannot enter the market freely. There needs to be liquidity freed up in order for the institutions and the composite man to be able to get involved in the positions they want to get involved in. In order for them to free up liquidity, they have to take liquidity out of the market. They have to take the dumb money out of the market. So essentially what's happened here, they're giving false signs of what price wants to do, or essentially building an area of liquidity. And then before we can take off, we clear that liquidity and we've started to make a move higher. Exact same things happened here. We've created that level of support and liquidity, cleared that, moved again. And what I therefore believe is because we've done this now, not only once, but twice, price is ready to take off. This in itself is a very, very nice reaccumulation. We've seen a nice reaccumulation within the reaccumulation, a pullback to tap into a very clear level of demand. So this is shown as demand is taking control. Okay, we've had a nice reaction as we've pulled into that zone, looking at the candlesticks as like a nice hammer candlestick, a nice doji candlestick that's showing signs of the supply and demand balance being brought to a halt and then demand retaking control. And then we can see towards the end of the week, demand's been introduced. We're making a move higher. And ultimately on this 4 hour, as I look at it now, we can see again where we've had the tap, we're moving higher. There's a lot of momentum. So there's two ways that I'm going to look to tackle this market, okay? The first way is if we start looking at demand zones, we can see there was one here that's already been mitigated. There's one here, which I'd argue has already been mitigated. So essentially, the only zone left is this region right here. So there's two ways that I might enter this. I understand that we're still within a trading range. We're still within a reaccumulation schematic. And where I was talking about before how we've got two different phases of a market, if I just zoom back out to help us understand this, the phase that we've seen is we've had a accumulation formed. Whilst we're within the accumulation range, that's when we'll actually see pullbacks into demand. We do get a few pullbacks into these demand zones. And then once price is fully taken off, it takes off. Same again here, we've entered reaccumulation. Once we've done the liquidation, we do have some pullbacks into levels of demand, but then ultimately, once we've left the trading range, which we have here, we then take off. What I'm essentially looking for using past data of what price typically does in these regions is two things can happen, where we've either got one more pullback left in the market where we'll pull back into a demand zone before rallying higher, or if there's just that much momentum in the market right now, what might actually be happening if we look on the 1 hour, this might be another reaccumulation again, where we see this level of liquidity is getting built. So ideally, best case scenario, what happens? Well, the same thing that we keep seeing in these levels where we have a manipulation, maybe we tap into the zone, clear liquidity, and then we take off. And as we take off, we have these reaccumulations form as stepping stones. And how do I enter in on these? Well, once I see that price is liquidated, I've got a few different ways of entry. Once I see the liquidation and an instant sign of strength from the demand zone tap, we can start looking to enter in these regions. But if I want to start getting involved in these reaccumulations, it's a similar thing. Once we see the liquidation, we can get involved after price breaks the high, so it's showing signs of breaking up to the upside. Stop loss below this, take profit where we like, or we can do that on a lower time frame, or again, we can go even riskier, that once price is liquidated, we get in quite quickly after the liquidation with a tighter stop and we move higher. If we miss this entry, we get in again on the next reaccumulation, and we keep edging in on positions as these stepping stones go until we start to see signs that that momentum is slowing down. We need that next pit stop, in which case, again, we'll allow price to reaccumulate before entering again. Now, where did I make mistakes? I tried to trade this market too much over the last couple of weeks. What do I kind of mean by this? Well, we always know that when the market's sideways, that's when the composite man is most actively trying to manipulate people into losses and most actively trying to give as many false signals and throw bait as much as possible to make people lose money. And therefore, statistically, we're much less likely to get winning positions in a consolidation period than we are when price is trending really, really nicely. So what should I have done? What could I have done essentially? Yes, I could still easily have traded this market. I'm not going to sit here and say you couldn't have, because there's still very clear regions. The price has tapped into and kind of respected demand zones. If we take the overall sell to buy here, we can see that the liquidation came to tap the zone before taking off. Okay, the liquidation came to tap the zone before taking off. It would be nice to see that happen one more time. Liquidation taps the zone, we take off, but I can also appreciate that at the same time, price might just continue. And this leads into how I want to wrap this kind of thing up is in trading, we react. Okay, yes, we predict, but ultimately we don't trade based on our predictions. We trade based on our reactions to what price gives us in real time. What do I mean by that? I can sit here and say price is definitely going to do this, but I never know. There's a lot of fundamental news. There's a lot of political and economical instability kind of brewing up in the world right now. So anything could happen come Monday. And as a result of that, we could instantly show tons of weakness and plummet through. And if that's the case, I'm just going to react. I'm going to redo my analysis, change my bias around that new information I've been given and react accordingly. Or if there's tons of strength, we might not even pull back into here. We might just take off. In which case, again, I'm waiting for these little reaccumulations on the lower time frames to enter in on over the top. Just using this time frame because it's where we've recently had a reaccumulation from. How would I go to trade this? Well, if we have this kind of structure built on a lower time frame where we've had, again, liquidity created, liquidity cleared, once that liquidity's been cleared and we see that big sign of strength, we see a slight little reaccumulation here, we could enter at this point, stop loss below the low, and we can hold that run and trade. Same again here, we see reaccumulation, manipulation of the low. We then have our buy limit here so that once price trades through that high, we're involved in the market. So another potential position we could have looked at. Same again, just after we've had the demand zone tap, we've had another kind of reaccumulation in this region. We could have entered in on that reaccumulation so many different ways. Or we could have played the much safer option. Cool, once price breaks this high and gives signs of strength, put our stop loss below the low, and I'd take profit way higher if we didn't want as much of a refined entry. Hopefully that explains my bias on the market pretty well, and you can understand kind of how I tell myself the story of what I want price to do moving forward, because that is ultimately step one of our 3-step approach to the markets. This is my system, this is my strategy that I will strictly follow. And a big part of step one is creating a story and a bias. So I mean by that, you should be able to look at a market and like I have, spend 15, 20, 30, 40 minutes telling yourself a story of, cool, this is what I think price is likely going to do. This is how I'm reacting to the market, given previous data, given price action, given technical analysis, given fundamental analysis, creating that story in your head to fully understand what this market is doing, has done, and is likely to do moving forward. And I want to become so obsessed with analyzing this market structure, how it typically moves. You know, what I've done in this video so far is I've referenced so many times, I think this will likely happen because it's happened so many times previously. You know, when we're talking about the liquidations and moves higher, I think it's going to happen because it's already happened so many times previously. When we spoke about getting involved on the reaccumulations rather than the pullbacks, why is that valid? Because it's happened so many times already previously in the market, and I'm using back testing and I'm using previous data in the market to help me create almost like a collation of information of what statistically happens more often than not in this market. Hopefully that gives a good rundown as well as to how I use Wyckoff price cycles to understand what cycle of the market we're in. Are we in an accumulation? Are we in a markup? Are we in a distribution? Are we in a markdown? I have to approach each cycle and phase differently. I have to trade it differently because I understand what's going on in this supply and demand balance is completely different in every phase. And the composite man's intentions in every phase is also very, very different. And therefore, if I'm not aware of the composite man's intentions, I therefore can't avoid being manipulated by him, but then I also can't get involved in the positions of the footprints they leave. If you'd like a bit more information on how I understand the composite man's intentions during each phase of the Wyckoff price cycle, let me know and I can dive into that. Hopefully that gives a really good rundown of gold and you know what I'm looking for. So if you did enjoy that, leave some feedback, let me know. And if there's anything you'd like me to expand on, drop that below and I can make sure to make more videos.